Alrighty folks, this is the 11th video on the Maybe series and the 19th under accounting. In this video, we're going to be talking about a specific type of interest called PIK interest. And PIK stands for payment in kind. Right? So based on that name, it kind of sounds like we're paying this interest in kind, in kind of in a similar fashion, I guess, if that makes any sense, right? And what PIK interest really is that instead of paying just dollars as an interest expense, we're paying cash, we instead just increase the loan amount. Why is it doing that? Sorry. By the interest amount, right? So we're essentially just letting the interest kind of accrue, right? It's a little different, but that's how I want you guys to think about it, right? So normally, right, when we went over how interest affects all of the three statements, what did we normally do, right? We start out on our interest, on our income statement. Let's say it's $100 worth of interest. We do minus 100 at a 25% tax rate. It's minus 75 on net income. That flows through to our cash flow statement. And then our cash is down by 75. Our shareholders' equity is down by 75, right? So that's basically how interest works. If you guys aren't familiar with that, check out the video on debt on the three statements. But in this scenario, we're not going to pay off that interest at this point in time. We're just going to let it accrue further on the loan amount, right? So let's assume that it's $100. So we have PIK interest of $100 at 25% tax rate, right? So let's look at how that would look on the three statements. So on our income statement, we have our EBIT. We're going to subtract out our interest expense, right? So this includes PIK interest, and that's going to be the 100, right? Meaning that this leads our earnings before taxes, our pre-tax income, to be down by 100, and our taxes are going to be adjusted by 25 because there's a 25% tax rate, meaning that our net income is going to be down by 75 overall, right? Now we move on to the cash flow statement. The cash flow statement obviously starts off with our net income figure that's down by 75, but now we have to remember that we didn't actually pay this interest as cash. So this just accrued further onto the loan. So essentially it was just an increase on the loan, right? Or we can call this PIK interest, or whatever you'd like to call it as a line item. It's not that important. So what ended up happening is our net income is down by 75, but in reality, that interest just accrued on the loan. So we had $25 worth of tax savings, and we didn't pay anything out of pocket. So that means that our cash overall is going to be up by 25, right? Because that's the $25 worth of tax savings that we got. So let's start off on our balance sheet. So under assets, we have our cash that is up by 25. Then we have our liabilities. That loan amount has increased by 100, right? Because we let this PIK interest accrue on it. And then our shareholders' equity is going to flow through from our net income, right? So that's going to be down by 75. So let's check our formula here. Assets equals liabilities plus shareholders' equity. We know that cash went up by 25. It's a positive 25. Our liability amount went up by 100. And our shareholders' equity went down by 75. So that shows us that both sides are up by 25 if we net those two numbers out right here. So our balance sheet balances. So, in terms of how common this question is, I would say it's not quite common. However, there is an elite boutique or two that does ask this question relatively frequently. So, it is something to kind of keep in mind overall, right? I would say the other topics are far more important overall, but I mean, it's a pretty simple concept, right? We just let the PIK interest accumulate on the loan. It's going to increase the loan amount, and that's why our cash is going to be different because we had the tax savings, right? And net income just flows directly from shareholders' equity. So I hope that makes sense, and we'll hop into the next one here.